The US set to slap India with a crushing 50% tariff on some Indian goods, the highest in Asia. The move has perplexed officials and analysts alike as to what Trump really wants from New Delhi. Live from Sydney, I'm Paul Allen, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, the tariffs threaten India's exports to its largest market, with some industries such as textiles and footwear likely to be hit hard. Economists see the 50% levy hitting GDP growth, and we'll get an assessment of the economic impact from Nomura's chief economist for India and Asia, ex-Japan, Sonal Varma, in just a few minutes. Meanwhile, American pressure is bringing India, China and Russia closer. But can this alliance hold as Beijing and New Delhi still have several unsettled differences? We'll get a view on this from Hoover Institution fellow Sumit Ganguly, who thinks India may be placing a bad bet on China. Our top story today, India bracing for a massive tariff shock from the US as the Trump administration plans to slap a 50% levy on some Indian goods. The higher tariffs are scheduled to take effect within the hour, doubling existing 25% duty that was implemented back in August 7. The move deals another blow to ties between Washington and New Delhi, which have taken a turn for the worse as President Trump punishes India for buying Russian oil. For more, let's get to our India trade and economy reporter, Shruti Srivastava in New Delhi. So, Shruti, the United States obviously the largest export destination for India. What impact is this going to have on India's exports and its growth prospects?
Yeah, so as you said that this is going to double the levy. So Indian exporters were paying 25% from beginning August 7th. That was high. And with this 50% tariff, which kicks in 9:31 a.m. today, the tariffs are higher among the Asian economies. This is definitely going to render Indian exports uncompetitive in the markets. And of course, it will damage its key markets. It will damage its competitiveness compared to its Asian rivals like China and Vietnam. So as some economists have said that it'll shave off some 1% from India's GDP, but that's the broader perspective. Labor-intensive sectors like textiles, footwear, and gems and jewelry, they would be among the hardest hit, and that is where the pain lies. The government is, of course, this has left the officials in New Delhi stunned, and they're huddling together now to figure out ways to support exporters. As you said, US is the largest export destination for India. But despite that, there's one thing that perhaps can save India, and that's the consumption. India is largely a consumption-driven economy and not an export-driven economy. And while India exported some $87 billion worth exports last year, that's just 2% of India's GDP. So the government is trying to boost consumption in India. It has recently announced major overhaul in its consumption tax regime. It has cut consumption tax, and that should kick in by, say, in the next couple of weeks. And that should probably, shield the nation from some of the economic pain that is going to arise from these crushingly high tariffs.
So experience previously with other countries suggests that these sorts of disagreements around trade with the US eventually get ironed out. What's the plan for negotiating this 50% down to something a bit more reasonable? And simply put, why doesn't India just stop buying Russian oil?
So we have seen that the relationship between the two nations has frayed in the last few weeks. Trump has blasted India for its continued purchase of Russian oil, but New Delhi has struck a defiant note. It has said that the purchasing of Russian oil has stabilized the energy markets, and it has been financially viable for the country to continue doing so. Let's remember that ever since Russia had a full-scale invasion in Ukraine in 2022, India has ramped up its purchase of oil from Russia, and according to some estimates, some 37% of Russian exports of this oil come to India. So India is unwilling to budge on that stance. And despite being one of the first nations to start trade negotiations with the US, it has not been able to secure a trade deal. And with the current tariffs coming into, kicking in from today, there is currently no reprieve for India in sight. Also remember, on some of the red lines that India has drawn in its negotiations with the US, it has refused to give greater market access to American agriculture and dairy products. And that has been one of the peeve points for the US negotiators also. So there are a couple of things which need to be ironed out for the two countries to move ahead with their trade negotiations. And that doesn't seem to be happening anytime soon.
All right, India and economy reporter Shruti Srivastava in New Delhi. Thank you. Well, let's get to the economic impact of the tariffs with Sonal Varma, Chief Economist, India and Asia, ex-Japan at Nomura. Sonal, I want to put a similar question to you. Given the steep 50% tariffs imposed and, the US being India's largest export destination, what are your expectations around the impact on growth?
Yeah, Paul, I think the biggest question is how long do we think these tariffs will last? So if you split the 50% into 25 reciprocal and the 25% penalty, the 25 reciprocal we think will largely stay at these levels through this financial year because India has made its red lines on agriculture fairly clear. The other 25% that kicks in today on the Russian penalty, again, India has taken a clear, firm stance on that. But it is possible at some point in time for, let's say a peace deal between Russia and Ukraine or other factors to drive this penalty down. So our working assumption right now is the penalty stays for about 3 months, beyond which it is taken away. So when we put those assumptions together for FY26, there will still be a material hit to growth because of the weaker exports. For this year, we've cut our growth projection to 6% from 6.2% previously. That's below the RBI's forecast of 6.5%.
Well, Prime Minister Modi has been defiant, as Shruti was saying there, when it comes to the purchases of Russian oil. If India were to stop buying Russian oil, what would that mean for energy prices, growth and inflation in India?
Well, I think currently, if you look at the cost saving that India has achieved because of buying Russian oil is actually not much. When the imports had begun 3 years back, the discount on Russian oil was over $12 per barrel. In the last 12 months, our estimate is that discount has come down to around $1.50 per barrel. So in a hypothetical scenario where there's ample global oil supply, which is actually the case right now, switching over to another source actually will cost India less than 0.1% of GDP per annum in terms of additional current account, or additional oil import bill impact. So, but that is obviously a hypothetical scenario. I think the question is whether we do expect oil surplus to continue globally. And I think more importantly, from India's perspective, the question is one of more medium-term energy security. The fact that other countries buying Russian oil have not been singled out, and US and EU buying other Russian products, is still ongoing. So I think the issue is more with respect to energy security and sovereignty, and less to do with the discount or cost saving that's coming on account of Russian oil here.
Well, India is also going to be cutting consumption tax. What's that going to do for consumer demand, and how's it going to contribute towards filling the revenue hole?
Yeah, on the consumer demand side, on aggregate, we think for FY26, the impact should not be that material, but there will be differentiated impact for different kinds of consumer goods. So typically for low ticket and low price consumer demand, where demand is more price elastic, the potential reduction in prices should lead to an increase in volumes. So things like sales of two-wheelers, for instance, can pick pick up. But for other high-priced consumer items, some reduction in prices typically leads to first a postponement of demand in the anticipation of lower prices and then a bump up in demand once the prices have come down. So we're expecting August and September to be actually a period of soft retail sales because of the expected cut, and then October and November should see a bump up in consumption. But overall for FY26, we don't think there'll be a material impact. So on net, we think the negative impact from tariffs will offset the GST impact. The fiscal impact, we're still awaiting more details on this. I think our own assessment is that states will not agree to a game plan which entails a significant tax revenue hit for them. And there is the GST compensation cess, which has some surplus funds which can be used to compensate for any transition loss that arises on the fiscal front. So we think for FY26, the fiscal impact will be minor, will not be material as is being feared currently.
Well, we've got some GDP numbers shortly coming out for the second quarter. Expect to see a slowing there to 6.7%. Still a pretty healthy clip, though. What are your expectations around that number, and as well as future quarters when the tariff impact starts to be felt?
Yeah, the April-June quarter should still see a reasonable growth. Our own estimate is around 6.9%. We've seen significant front-loading on the export side, so net exports should be a big driver. The government as well has front-loaded its own capital expenditure because private capex is weak, so that should drive growth. And good agriculture output should also support rural demand. So the other segments of the economy like urban consumption, private capex remain weak, but a combination of these factors we think should still drive growth number of 6.9. The final factor that's supporting growth is really very low deflators in India, so that's boosting up real growth. Now, this is backward-looking data. I think what matters really is what lies ahead of us, and the full impact of the tariff in our view, will be visible after September, and GST will lead to some slowdown in the near months and then some pickup in the October, November months. But overall, ultimately, the driver for consumption and capex will be how sustainable demand is domestically as well as on the exports front. So we think second half of the financial year, which is from the October to March period, could see a sharper slowdown in growth to potentially below 6%, even though the starting point is good.
And do you expect any policy response coming up later in the year from the RBI? Is there anything already priced in? And what's your timeline for the potential scale or timing of any future easing?
Yeah, we do think there will be more monetary policy support that will be needed. And fortunately for India, inflation remains below the RBI's target. So inflation is not at all a concern, and growth appears to be below trend. So we think the Reserve Bank will cut rates in October and follow up with another cut in December. So we're building in 5% as the terminal rate by end of this year, which is actually more than what consensus is currently building in. But that said, I think outside monetary support, clearly the need of the hour is also more targeted export support at this stage.
Just finally, I've got to ask you, we're seeing a lot of upheaval and political pressure being exerted at the Federal Reserve in the US at the moment, also expecting to see a cut from the Fed next month. How vulnerable is India's economy and general risk sentiment to what's going on there at the moment?
I mean, I think in general, the spillovers from there to EMs has been very much manageable, I would say. So from the currency spillover channel in particular, dollar has been on the softer side. So that's been a sigh of relief for a lot of currencies, including for India at the margin. And the prospect of Fed cutting rate always gives a bit more elbow room for central banks in Asia to actually cut policy rates. So unless this triggers a massive, risk off and therefore capital outflows from EMs, I think the spillover at this stage actually, I think, is more positive in terms of allowing more room for the likes of Reserve Bank to cut rates. I think the only thing we are monitoring is the increase in long end bond yields in some of the DM markets and whether that leads to any spillover. But at this stage, we think things are manageable.
Mm-hmm. All right, Sonal Varma of Nomura, thanks so much for joining us with your insights today. Still to come, former Fed Vice Chair Lael Brainard issues a stark warning over President Trump's move to oust Governor Lisa Cook. We'll hear from her next. This is Bloomberg. Former Fed Vice Chair Lael Brainard suggests there is a real risk that multiple Fed district bank presidents could be removed from office next year. She views President Trump's latest moves against Lisa Cook as part of his pressure campaign on the central bank.
This is not about an individual governor. This is really an unprecedented attack on the independence of the Federal Reserve as an institution. There is nobody in the Federal Open Markets Committee, the Monetary Policy Setting Committee, that can't be thinking, well, what does this mean for me? And so any member of the board, presumably, is going to worry that they too could be subject to this kind of political pressure. And that fundamentally undermines the institutional independence of the Fed, which means higher inflation potentially, less credibility, even higher long-term interest rates, bad for the economy.
Do you think this can actually impact how members are thinking about monetary policy?
Well, I just think the implication, if any member of that board could come under this kind of political pressure from the White House, and of course we saw that kind of pressure on the chair earlier this year, I think that does really put a higher premium on whether they're going to be willing to speak their minds, to dissent on key votes if necessary. I think it really does create unprecedented risks.
The president in his letter talked about this mortgage allegation fraud in the mortgage world for Governor Cook. What if she was charged or convicted?
Well, I think what is important here is due process and undertaking a real investigation and having the facts on the table and the ability for her to defend herself legally. None of that has taken place here. The White House has preempted the process, and so that is why it's really unprecedented. It's very, very threatening to the very independence of the Federal Reserve, and it should cause concerns, I think, among investors and more broadly about that fundamental underpinning of our strong economy and our strong financial markets.
That's former Fed Vice Chair Lael Brainard speaking with Bloomberg TV. Well, Bloomberg Economics Chief Economist Tom Orlick is also weighing in on President Trump's threats to the Fed. In a new analysis, he says while markets have largely shrugged off Trump's other encroachments on traditional governance norms, Fed independence is the one place where the governance rubber hits the market road. He joins us now from Tokyo. Tom, are markets paying enough attention to what's going on with the Fed? Because if we look at risk assets at the moment, well, it seems like situation normal right now.
So I think it's a great point, Paul. If we look at equity markets, certainly doesn't seem like a huge amount of concern. But I think actually it's possible to square the circle between the market focus on Fed independence risks and those rising equity markets. What markets are betting on, I think, is that Trump will succeed in exerting influence on the Fed, and that will lower short-term borrowing costs. That's one of the reasons why equities are still rising. But if we look at the long end of the curve, if we look at what's happening to borrowing costs for the US government at the 10-year horizon, at the 30-year horizon, they're pretty elevated and indeed continuing to edge up. And what that tells us is that markets are concerned that these challenges to Fed independence, they might mean lower short-term borrowing costs, but they could mean unanchored inflation expectations, higher inflation going forward, and so higher interest rates into perpetuity.
Well, Bloomberg Economics has also come up with a new Fed Independence Index. Can you walk us through that and tell us what it shows?
So what we try to do, Paul, is come up with a kind of objective, data-driven way of gauging the degree of independence for the Fed and other major central banks. So focusing on the Fed index, what we see in the latest readings is a sort of fairly significant increase in threats to independence. What's driving that? Well, there's a couple of things. First and most strikingly is the attacks from the White House on Chair Powell, on Governor Cook, the calls for the White House for significant interest rate cuts. That's pretty unprecedented. You've got to go all the way back to President Richard Nixon and Fed Chair Arthur Burns back in the 1970s to see such sort of striking attempts by the executive branch to influence Fed policy. The second thing which is dragging the index down is the Fed missing on its attempts to control inflation post-pandemic. Of course, we just had inflation rocketing up almost to 10% as supply chains got sort of jammed up after the pandemic. And what that means is, well, social support for the Fed just isn't particularly strong right now. And that adds to the problem for Powell and co., right? Because Trump is attacking them, saying they're not doing their job right. And the American public, well, they remember the Fed was in charge when inflation rocketed up to 9%. So they might be inclined to agree the Fed hasn't been doing an amazing job in recent years.
Is there a risk, though, of, be careful what you wish for? Let's assume President Trump gets his way, is able to apply political pressure, manages to deliver a huge cut in rates. Well, he'd own the whole economic story then, including any inflation that results.
Yeah, I think that's completely right, Paul. And indeed, that's what we're seeing the markets moving towards, right? Short-term rates down as the markets place a higher probability on rate cuts in the near future. Long-term rates high and rising as markets place a higher probability on unanchored inflation expectations, which ultimately force interest rates higher again. So, as you put it, it's a case of be careful what you wish for. And indeed, this is the big reason why central banks are independent, right? Because if politicians are calling the shots, they'll always want lower interest rates today. But the consequence of that is higher inflation, higher interest rates, and ultimately everyone worse off in the medium and longer term.
All right, Tom Orlick, Chief Economist at Bloomberg Economics, joining us there from Tokyo. Still to come, going to be counting down to fresh US tariffs on Indian goods due in the next hour. And we'll discuss the rift between Presidents Modi and Trump and how we got here with the Hoover Institution's Sumit Ganguly. That conversation next. This is Bloomberg. Welcome back. You're watching Inside. Here's a live look at Mumbai. We are about 30 minutes away from a new wave of US tariffs on India. Washington's latest move will result in 50% tariffs on some Indian goods, which would make it the highest level in Asia. And the White House outlined the levies in a pair of notices earlier this week. It's a clear signal that any last-minute reprieve, looking pretty unlikely at this point. It's a stunning turn of events for officials in New Delhi. The months of trade talks proving fruitless as relations frayed over India's purchases of Russian oil. Now, the rift is also pushing India closer to regional rival China in a significant shift in regional dynamics. Now, on that note, let's get to Sumit Ganguly, Senior Fellow at Stanford University's Hoover Institution. Sumit, thanks so much for joining us. I know this is a topic that you have been writing about, potentially India and China being driven closer together by the realities of geopolitics. What's your opinion of this potential warming of ties between Delhi and Beijing?
This potential warming of ties enables the two sides to tide over a rather difficult set of circumstances that they are confronted with. Both face a trade war with the United States, and as a consequence, they feel that at least a moment of solidarity might provide them a bit of reprieve.
Well, the US, as we've been discussing, is the biggest destination for Indian goods. China, though, is a close second. Is there an opportunity for China to become a more important export destination for India?
At least in the foreseeable future, I see China becoming a more attractive market for India, though India may not easily be able to substitute one market for another, because certain goods and services and certain products were destined for the American market and specifically geared to the American market. Indian jewelry, for example, Indian textile manufacturing, both of which have been hit with this 50% tariff, or is about to be hit in about another half hour, unless there is some miraculous reprieve. I'm not sure that the Chinese would necessarily want to buy the same jewelry that Americans were purchasing, or for that matter, that China would necessarily buy Indian textile products. So this is going to hurt those industries in particular, especially hard.
Well, Beijing has been on a diplomatic charm offensive since President Trump returned to the White House. Certainly here in Australia, where I am, the China-Australia relationship's done a dramatic U-turn from where it was during the pandemic. But what are the risks for India in improving its ties with China?
There are substantial risks because the Chinese market could prove to be entirely mercurial. Chinese decision makers at the drop of a hat might change their minds. There is that prospect. In addition to that, there are structural issues that still divide India and China. For example, the border dispute, which after 24 rounds of talks is no closer to a real resolution. The confidence-building measures that were put in place in 1993 and 1996 have completely frayed, and this was more than evident during the Galwan Valley crisis of the spring of 2020, when 60 Indian officers and men perished and an unknown number of PLA personnel also lost their lives. And without even a shot being fired, this involved hand-to-hand combat. In addition to all of this, India and China have self-images of each other as great powers in Asia. And there is a Chinese saying, or some equivalent thereof, that at the top of a mountain, there's only scope for one tiger. And with these two large animals competing for status in Asia, in the Asian order, they're bound to clash to some degree despite economic interdependence. Excuse me.
Well, a year ago, the India-US relationship was in a very different place, a much warmer place. And just recently, the Indian foreign minister described, used the word perplexed when describing this reversal in ties. What's the game plan here for the United States? Is the rest of us missing some strategic advantage that President Trump can see and we can't?
President Trump is using trade to coerce India to, in part, obviously, to make certain trade concessions, particularly in the dairy and agricultural sectors, and those concessions, I can assure you, at best will be cosmetic. But beyond that, I think one of the problems which really has been somewhat subterranean in this entire exchange is that Trump is seriously piqued with Modi and Foreign Minister Jaishankar's insistence that no foreign power, and especially the United States, was not integral in bringing about the ceasefire between India and Pakistan in the wake of the Pahalgam crisis in Kashmir in late April, early May of this year. Trump wants to claim that as a major diplomatic victory because he thinks this would be another notch on the butt of his gun, which would enable him to get one step closer, possibly to receiving the Nobel Prize. I think the prospect of Trump receiving the Nobel Prize is frankly a mirage, even though a handful of countries have nominated him for it, including Pakistan. But India's insistence and the firm public insistence by high Indian officials that Trump played no role in resolving the crisis is something that has genuinely irritated him and has gotten under his skin.
Well, I'll resist the temptation here to embark on an exploration of the president's ego, but perhaps instead focus on another sticking point, and that is Indian purchases of Russian oil. I mean, we were hearing from Nomura's Sonal Varma a little bit earlier, who was saying, look, the net economic benefit to India purchasing Russian oil perhaps isn't really all that great. So would it not be politically expedient for India to just stop buying it?
It is actually somewhat beneficial, and furthermore, a number of key Indian refineries have geared themselves to refining Russian oil. So the substitution costs would not be insurmountable, but they would be costly. And furthermore, those refineries happen to be primarily in the western state of Gujarat, from where Prime Minister Modi hails, so there would be also a political cost in making this concession. And furthermore, it is important to underscore that initially Trump had gone along with Biden's policy of capping the price of oil and letting India import the oil, refine it, and then sell it on global markets. This whole issue of using this as a point of leverage arose almost simultaneously with his speak about other matters, so which suggests that cutting off India's access to Russian oil isn't really the key motivation driving Trump.
So if we set aside Russian oil as a motivation, and as you say, any concession India makes on agriculture would be window dressing at best, what do you see the US wanting from India in 2025?
Basically getting the Indians to buckle. And I think that is going to be a tall order. This particular government in India does want good relations with the United States and has worked very hard to sustain that relationship. But I think that under duress, this government will find it exceedingly difficult to make significant political concessions because of the likelihood of a domestic political backlash, including from within its own ranks. This is a very nationalist government, and it has cultivated this nationalism amongst its supporters, and to make an about face and to seemingly cave in to Trump's demands would entail, in my judgment, very, very significant political costs.
Yeah, it's an interesting point you make, because typically when a country feels disrespected, there tends to be a rally around the flag effect. Could there be a potential benefit for Prime Minister Modi here?
Yes, certainly in the short term, there is already a rally around the flag syndrome. But if Modi is perceived as being weak, if Modi is perceived as making too many concessions to Trump, especially under duress, I think this sentiment, which is quite supportive of Modi at the moment, could quickly dissipate.
So how long do you think India can realistically endure these 50% tariffs on its products entering the US until something gets worked out?
Perhaps for the next several months. Modi could encourage domestic production by providing subsidies. He could provide tax relief. He could direct trade to some degree elsewhere. But these are palliative measures. Bear in mind, as you said very early in the program, that the US is India's largest trading partner, and easy substitution will not be possible. So I have read certain estimates that India could lose as much as 0.5% to 1% of its GDP over the course of the year if these tariffs are sustained. And over the long term, this is not a sustainable strategy.
Given what you said earlier about what Trump wants from India, how do you suspect the White House is viewing, to bring it back to what we were talking about earlier, the current warming relations between India and China?
The White House, if anyone is paying heed, and if Trump is paying any attention to the meager number of advisors that he has who are still willing to speak truth to power, it should be a cause for concern, because the recent meeting of the SCO, the Shanghai Cooperation Organization, which the PRC spawned several years ago, there was this bonhomie between Putin, Xi Jinping, and Modi. Now, all this is the product of circumstances, and you could well say this is merely an expedient and contingent on the present circumstances. But it does not bode well for the United States to see these three great powers in Asia at least coming together momentarily.
How would you characterize India's relationship with Pakistan at the moment?
Oh, India's relationship with Pakistan is perhaps at the lowest ebb in decades for several reasons. One, there are significant raw memories of the horrific terrorist attack by an offshoot of a Pakistan-based terrorist organization, the Jaish-e-Mohammed. And this is an organization called the Resistance Front, which in cold blood killed 26 tourists, the vast majority of whom were Indian, and after carefully checking them for their religious affiliation, to see if they were Hindus or non-Muslims, and then they were selected to be killed in cold blood. And Subsequently, India's military did not perform as well as expected in the ensuing conflict that took place in early May. Subsequently, the Indian Air Force performed well, but not in the first 2 days, and that in turn has wounded national pride. And third, Trump's courting of General Asim Munir, who's the chief of staff of the Pakistan Army, to a lunch at the White House, and investment in Pakistani cryptocurrency, and the prospect of looking for oil, which, by the way, is chimerical. I know the figures. Based upon geologic surveys, Pakistan has 0.02% of the proven oil reserves in the world. So that is likely to prove to be a mirage. But nevertheless, the mere fact that the U.S. has talked about prospecting for oil and working for Pakistan to look for oil and natural gas, all of these three factors have really piqued the Indians in the worst kind of way.
Is there an opportunity here for China to perhaps step into the role that President Trump fancied for himself in terms of brokering some sort of peace between India and Pakistan?
No, I think that's almost next to impossible, because the differences that exist between China and India, and particularly China's support for Pakistan, including in the recent skirmish that took place in early May, when China provided real-time intelligence to the Pakistani military establishment, and in addition to that, it was Chinese fighters and Chinese-built anti-aircraft missiles that shot down Indian aircraft. That has been carefully set aside by Modi and his External Affairs Minister Subramaniam Jaishankar, but the Indian public is unlikely to forget the extraordinarily powerful role that China played in supporting Pakistan in this intense 4-day conflict in early May.
All right, some compelling analysis there. Thank you so much for joining us today. Sumit Ganguly, Senior Fellow at the Hoover Institution. Still to come, we have Nvidia due to report earnings later. Investors are eager to know if the company has enough access to China to keep up demand for its chips. We'll discuss their prospects next. This is Bloomberg. Welcome back. You're watching Insight, and we're keeping an eye on Capricorn shares this morning after the tech firm swung to a record profit in the first half of 2025. China's homegrown alternative to Nvidia posting a $144 million profit for the period versus a loss from a year ago. The firm is a reflection of a wave of demand for Chinese chips after Beijing encouraged the use of homegrown technology. Perfect time to talk about Nvidia, scheduled to release earnings after the bell this Wednesday. The highly anticipated results expected to provide a pulse check on the AI spending boom and shed light on how the US and China rivalry is impacting its growth. Now, this chart shows the stock's tendency to move sideways to down ahead of results. Bloomberg Intelligence senior analyst Rob Lee joins us now for previews. So, Rob, what are we looking out for this time for Nvidia?
Okay, well, unsurprisingly, we're looking for another strong set of numbers, but I think the key question is how much of that is already anticipated and priced in, with the stock trading close to an all-time high. The valuation has obviously come down as earnings have come up over the last 18 months or so, so I guess this stock is less richly priced compared to prior periods. But as you said in your prelude, these numbers will be released at a time when maybe the question question marks about the commercial outlook for AI are more in question at the moment. For those of you who look at US stocks, for example, there is a quite high-profile company called CoreWeave. And if I remember, when they reported and their outlook was disappointing, stock was trading down 20%. So I think the sort of sentiment towards AI is changing as we progress through this cycle. I think the numbers themselves for Nvidia will be fine, but there are the question marks about competition, as you said in your prelude with Combicon, the ongoing saga of H20, and also potential for rising domestic competition from the likes of AMD.
So in terms of AI euphoria, are we at the peak yet, or are we getting close?
Well, if I can find the right way to describe it, the sort of cadence, if you like, of this so-called beat and raise, the momentum of that for Nvidia has eased, certainly year to date. And if you look at the consensus numbers on the terminal, and for terminal users, you just use the EEG function to look at that, the consensus EPS estimate for Nvidia is almost exactly unchanged since the 31st of December last year. Now, some of that ties in again with this hokey-cokey on the H20. You know, is it on, is it off? Where are we with that? So there is some genuine uncertainty there. But as I said, the cadence of beat and raise, whilst the outlook for the business remains strong, it would appear that a lot of that is already anticipated by the market.
Yeah, is that can't they sell the H20 chip in China the biggest risk Nvidia faces, or is there something else for investors to worry about here?
Again, the fact that Jensen Huang previously was lobbying the US president personally and heavily behind the scenes, you know, obviously speaks volumes about the desire of Nvidia and others to try and tap into the growth opportunities within the China AI sector. But conversely, you know, taking a step back, the direction of travel for China tech sector is clear. The country is clearly doubling down on its efforts to be self-sufficient. From a Chinese perspective, the US has proved itself to be an unreliable partner. And obviously, the two superstates, if you like, are major geopolitical rivals. So I think you know, on balance, it would appear unlikely, unless we see some other significant change announced in the coming weeks, that Nvidia is going to really be able to tap into potential demand on H20. And as you saw from the headlines that came out last week, it would appear that the Chinese authorities are encouraging their local AI companies to buy domestically. And equally, there was an unconfirmed report that Nvidia was actually talking to its suppliers to get them to cease production on H20. So I think we should gain more clarity tonight. We'll wait and see.
Oh, all right. Bloomberg Intelligence senior analyst Rob Lee there. Now, I'm the wrong person for this, but before we go, congratulations for pop superstar Taylor Swift and NFL player Travis Kelce. They've announced their engagement in a 5-part post on Instagram captioned, "Your English teacher and your gym teacher are getting married." Well wishes for the couple are already pouring in online, and even from the White House, President Trump, who has been critical of Swift in the past for endorsing his political rival Kamala Harris, commenting on the engagement during a cabinet meeting.
I wish him a lot of luck. I think he's a great player. I think he's a great guy, and I think that she's a terrific person. So I wish them a lot of luck.
That is it for Insight.